Hello everyone. Right, we want to look at sales and cost of sales. There's an adjustment that you made, and this the first entry that you make on your income statement. Right, sales then followed by cost of sales. There's some adjustment that you often just see there, and most of those adjustments they will affect your trading stock. They will affect your data controls. Also, we'll try and adjust everywhere we need where the adjustment basically touches or affect, and make sure that when you look at that particular adjustment, you are aware exactly of what you need to do, what are things that you need to look out for. Right, it says you are provided with a pre-adjustment trial balance on 31 December 2020. Right, that means your year started on 1 January. Data's control was 280,280. Trading stock was 156,000. Then our sales was 3,345,000. Cost of sales was 2,090,625. Then adjustment. A credit note was issued on 31 December for 9,920. Goods were sold with a markup of 60%. So the markup of goods sold was 6%. Right, says no entry has been made of this transaction. There was no trading stock surplus or deficit at the end of the year. So this is very important. See, if you that means if you're gonna watch it later, or you watch the one that is has trading stock deficit, or you watch this one first, but you'll understand what exactly you do with trading stock deficit. How do you identify the trading stock deficit? Okay, right. I'm moving straight into the question. So the adjustment, you need to make an adjustment on sales. Right, you see this credit note here. These are what we call data allowance. Normally, you are given a data allowance figure in your pre-adjustment trial balance. So if you are given that data allowance figure, you adjust your sales with that data allowance figure. So now when you write this in your income statement, this is how it's going to be presented. Right, you will have your income statement, then there will be sales. Right, sales is 3,345,000 minus this data allowance. These are returns by customers. At once you issue credit note, acknowledging goods that were returned by a customer. So minus 9,920, right? So that will be the adjustment that you need to make. And remember, that's the selling price, right? Credit notes always are the selling price. Then we'll deal with this when you do the cost of sales. Then that figure will give us that's 3,345,000 minus 9,920. That will give you 3,335 and 8 335,008. Then you have your cost of sales. So your cost of sales is 2,090,625. Right. Remember, when these goods were returned, we need to reduce our trading stock, our cost of sales, because we had decreased our trading stock by the good that we sold, but those goods were returned. So what we need to do, we need to reduce our cost of sales by the cost price of the goods that were returned. So the cost price is calculated from here. So the cost price then will be 100 over 160. This is the selling price percentage. This is the selling price percentage, and this is the cost price percentage, right? So this multiplied by 9,920, right? That's 100 divided by 160 times 9,920. This will give you 6,200. So if goods are returned, right, the cost price of the good that were returned will reduce your cost of sales. So this one is 6,200 minus 6,200. So you must appreciate the cost price percentage and the selling price percentage. The selling price percentage basically is 100% of cost price plus 60% of markup. That's the selling price percentage, right? This will give us that's 2,090,625 minus 6,200. This will give you 2,084,425. Remember, this will be in bracket. Then you subtract those two, you get your gross profit, right? Then your gross profit will be minus 3,335 and 80. So your gross profit will be 1,250,655. That will be your gross profit. Then that's your GP. Then from GP, then what follows here is other incomes. This is where you have rent income, bad debts recovered, provision for decrease in provision for bad debts, commission income, trading stock surplus, right, not deficit. Then profit on sale of an asset, of a fixed asset. All those things, they come in here, and most of those I've done adjustment for some of those. I'm still to do adjustment for disposals, right? Profit on sale, loss on sale of vehicles. I'm still do adjustment on provision I've done. I think that's the only one that I need to, that may come here. Right. So then you see these amounts, these two amounts here. Right. This amount and this amount. Right. This amount here will affect your debtors, because you need to decrease your debtors control. Right, then this amount here will affect your cost of sales. Sorry. Excuse me. Your trading stock. Right. So if you go, let me just underline here. So right, if you go to your trading stock, right, your debtors control excuse me, your debtors control will be 2,280,280 minus 9,920. Then your trading stock will be 156,000 plus 6,200. Remember, you remove the 6,200 from cost of sales and you add it to what? To trading stock. So those are the things that you need to be aware of when you're doing that, so that when you go to note number, this is note number note 5, right? you're going to include the proper figure of the debtors control. Then this is not number 3. No, not number 4. 3 is fixed or tangible assets. So in good note number 4 and 5, right, you include the correct value of debtors control. Then good note number 4, inventory, include the correct value of trading stock. Note number 5, it's trade and other receivables. So include the correct notes there, the correct amounts they have properly calculated. So if you like this presentation, please do like the video, like the channel, as well as subscribe to the channel, and please share. And you can turn on your notification bell so that whenever I upload something new, you'll be able to notify so that I don't miss anything, because I'll do a number of these. Thank you so much.